Right. So again, back to basics. As we always like to say, this is the time where people have more of an open forum. We drop the gloves, if you will, or take the gloves off. I'm thinking hockey, you drop the gloves, it's a different conversation. But in this scenario, this is where people can share conversation, share ideas, case design, questions on product, and we kind of go through it together. So I call it like the iron sharpens iron. We have the ability to do a little whiteboard action, which I always like doing, even though it looks like chicken scratch. I got canned presentations. I've got, illustrations we can walk through, website walkthrough, anything you guys want. So I know in the pregame, the talk before the recording, Tia said she's got lots of questions, so I'm gonna let her fire away. So what you got, Tia?
Okay, so what I have is someone who wanted me to look at their year-old IUL policy.
Okay.
And it's a Transamerica Final Foundation. No, I'm sorry, I can't stop. Can't talk.
The
Financial
F,
Foundation IUL.
yeah, the f
Um,
you will.
I know, right? It's an increase in death benefit. The face amount is 300,000. They did a yearly premium, an annual premium for 2,500. 29 female preferred elite. And it was so, and then they have some riders, critical illness and um, I guess terminal illness. They have some other riders on here,
Mhm.
and they were initially sold the IUL as a retirement product. Right. So,
I'm gonna. Okay.
needless to say, um, I looked at the illustrations. It's not good. And I looked over and over again. It's somebody I know personally, so I looked over and over again, and I'm like, I can't be seeing what I'm seeing. But am I right? First question: am I
Yeah,
right? Is that part of the issue is that the death benefit is too high?
1000%. So, let's what I would say is let's kind of open it up for other people. Like I obviously have my opinions, but let's kind of go around the room and see who wants to offer some suggestions or thought process on how to your first opinions and maybe even some solutions. So I'll throw out Tilla, looks like you unmuted, so you're the first victim. I mean,
Yeah,
participant.
so hey guys, first of all, I'm kind of new here, so I just want to introduce myself. And that was the interaction. So let's jump into the solution. I think like the 2,500 bucks a year is like a really low like amount for the premium, right? That's what you said. It would probably make more sense to just put it in a Roth IRA, if like the plan is to save for retirement, especially since the life insurance takes a lot of like fees, and the growth is gonna be really slow. The only case when I would go with like life insurance, if I get it right, is if they want to access the money. So like if they really don't want to, like they say like it's a problem that, like they put away the 2,500 bucks and they can't access it freely. That's when I would go with an IOL. And then obviously, like the lowest face amount, because the face amount is too high. Plus they don't
Way too.
necessarily, kind of riders, even though the riders that you said, like terminal illness and critical illness, are probably, no additional cost riders, right?
They're
Right.
built
That's
in.
right. That's right. That's
Yeah.
part of the policy.
Yeah. There's always a cost, just so you know, but they're built in so you don't see an extra cost. So
Right. Right.
that's the misnomer with when people call them free living benefits. They're not free, they're just built
So
in.
there's no such as free.
Yeah, no free lunches, no nothing,
Oh yeah.
so yeah. But I think, Tilly, you're pretty spot on with that. So what I would say is that the face amount is just way too high.
Yeah,
Way too high. So at 29 years old, preferred best, 2,500, she should have a face amount around like 100,000 max.
that's what I
Um,
think.
yeah. Is
And
there
then I also suggested the
go ahead.
IRA as well.
Oh, okay. Well, so let me ask you this. Is there a illustration there? Like, do you have the original illustration by any chance?
Mhm. Yeah.
What's
Well,
what's
this
what's the
is this
target?
is the target. Okay, you got to tell me how to read that.
Yeah. So
Uh,
if let me
the
pull up, you found it?
Yeah, I'm looking at it here. So is
You're-
the target? I don't know how to read the illustration. That's the issue.
Are
Is
you like
it
asking because there's a huge commission and the previous sales agent just sold to make money?
typically
I'm
that's what
thinking that's
happens.
probably what happened. Yeah.
So if we look, I'm just gonna see if I can run one real quick to see where the target is. Because do you have it on the PDF that you can share it, or do you have the paper?
I have it. Actually, it's in my email. I may be able to share it. Give me a second here
Mm-hmm.
if I can pull it up.
Because typically what happens, and this is what we've seen from a lot of like, not gonna, well, I will, multi-level marketing groups, right?
That's
So a lot of,
exactly what happened.
oh yeah, and the minute you said trans, I'm like, World Financial Group.
Yeah.
Um, so, so you'll see here, like, ironically, a $300,000 face amount, 250 a month. This was just rando. You'll see it right there, TP, not toilet paper, but this policy right now is kind of toilet paper. TP would be your target premium, so it should be in the bottom
Um,
right-hand corner of every page.
okay. Gotcha.
Yeah.
Give me a
That
sec.
differs for different carriers, right? So if I run one with F&G, that just is on the first few pages. So we always have to kind of look for it, right?
Oh,
Okay.
it's hidden. Some people will call it BP. Some people will just say target. Corbridge says FCP. So it's always interesting to try and find it. It's like a game of Where's Waldo on the illustrations. So yeah, if you look in the bottom right-hand corner, it'll tell you what TP is, and I'm willing to wager it's 2,500 because this is a 35-year-old and it's showing target premium at 300K at 29.97. So this person is 6 years younger. So I would assume it's probably gonna be around that.
I'm still looking.
It's all good. So
Uh, talk while I
so
look.
oh no, you're fine. I trust me, I was going to. So there's some things that you would do to kind of alleviate and help that person in this scenario. So what I'll share with you is what I would consider the following options, and I'll put it in notes here so you guys can see it. So what I call this is fix a uh, fucked up policy. So step one. Call a carrier, and you typically need the client on the phone with you, okay? Because they're not going to give you information unless you're the agent of record or servicing agent. So call carrier and see if you can reduce the face as low as possible with no surrender penalties or tax implications. I don't know why it's not. There we go. Okay, so what happens, I'll give you my experience with Corebridge. Corebridge, I worked with a large MLM company where they would have a similar issue. So I recruit Tia in, I sell Tia her first policy, and I'm not going to get stiffed on comps. So I'm going to say a target funded LIRP strategy, LIRP, Life Insurance Retirement Plan, which means that there's a lot of space in there for fees and cost of insurance. Okay. If I, with Corebridge, then said, hey, Corebridge, year two, like I know how to run LERPs now myself. I'm in the business, and I'm like, my upline sold it to me completely wrong. I need not 1 million, I need 500K in face amount, but keep the same premium. Well, Corebridge would say, well, you're technically surrendering half the contract, so you're going to incur surrender charges too and lose some money. People don't like that. Okay. And the reason why, and I'll just give you a background behind the scenes. Okay. The policy's not bad. The producer was. Okay. So the carrier is not going to recoup to make up for a bad agent. And that unfortunately is a problem with our industry, is a lot of people are taught the wrong way. Um, the policy is good, but when you think about it, the carrier spends over 100% of what they receive out in commissions to the marketing organization, the BGA, maybe the agency under the BGA, and the agent as well. So if the carrier is sending out all this money to sell these policies, and then immediately year two, the client tries to reduce the face amount, well, the agent still got the commission, and now they're trying to skirt the issue, and now the insurance company would be out on fees they're trying to get to recoup the cost. So that's why you have to ask that question, you know, when you look at the implications of taking and reducing the face, is there going to be an impact to the cash value that's growing inside of the policy? That's the first question. So if yes, then step two would be, in my personal humble opinion, change it from increasing to level.
Mm.
Okay. That will not incur surrender charges, but what does increasing do? Increasing keeps the cash value growing with the death benefit. So what happens is your net amount at risk never changes. But if she can't afford to maximize an increasing $300,000 policy, she has to then reduce the amount of charges that's going against the contract. And people call that a level LERP, but I call it rescuing in this scenario because you would want to at least mitigate and get it back to what it's supposed to be. I will show you an example of an increasing versus level with the guideline level premiums, because that's really where you want to be or close to that to get the policy working in the right direction.
Mm-hmm.
Now, if I should go back and say if no, find out how much they can reduce without turning the policy into a mech. Modified endowment contract. So those would be the steps that I would look at from the carrier's perspective, but you want to get them on the phone and on a recorded line stating exactly what you want or what you can or can't do. Because then at
Mm-hmm.
that point, the next step is process and how you can still repair this wounded policy. Okay. So from here, we have to just take it to the next level, which would be, Tia, you should probably get appointed with Transamerica so you can take over as servicing agent. Now, there's no commission in that. However, you already said it's a close friend. I'm sure you probably want to help them as much as you can.
Mm-hmm.
Next step would be allocations. What are they allocated in? How's it performed? I'm going to say it probably hasn't. Am I right?
You're right.
So what happens is you'll see, and I'll go to the IUL here, and let's take a look at the funds. So they initially start everything with this global index account. Who the hell knows what that is, you know?
I saw that too.
Yep. So typically what happens is, and let's be honest, we're all competing to some extent. If Attila and I are selling the same a product to a client, we each have the same client, and we're gonna try and say, well, he sucks. He's only been doing this for like a year. I have 18 years, and he might say, well, he sucks because he's biased to Corebridge, and I've got all these other carriers, whatever. So everyone's fighting. So I might show him an illustration rate at, let's say this, 7.25% with his global index account with nothing to prove, you know? Um, and I come in with, my conservative approach, 6% rate of return, S&P only, because I feel that's the better option. This should win because you're using that volatility controlled index that is designed to show better on a spreadsheet. And we talked about this, I want to say 3 weeks ago, where
Yeah.
we showed everybody at their volatility controlled indexes, flipped it to the S&P, and you just saw everyone go "Whoop," like that. So this would be the same thing, is they're using a volatility controlled index, and in return, what's happening is it should show quote unquote better returns. I've said it before, I'll say it again. Illustrations prove one thing, it's that ink sticks to paper. And so we need to be responsible for what we sell and ultimately put people in the right position from start to finish so they get exactly what they're expecting. So I lean more towards the S&P 500 because it has a track record, and you can validate this with a client and just simply say, S&P and P
Quick,
500 30-year returns.
quick
And you'll
question.
see.
Yeah. Do you rather allocate more to capped 100% participation rate policy or okay, that's
I usually do the cap. These usually have a cap because a lot of carriers won't do uncapped S&P because it can be erratic highs.
yeah.
You will see that in some annuities, like Lincoln right now has an annuity with a 55% participation rate on the S&P. But even then, if you think about it from so say Attila buys a policy yesterday and the market was where it's at, I buy it today, the market took a dumper again today. So he bought up here at his point, I bought down here at my point. Then next year, you know, who wins? So I could have a 10% return and until it could have nothing, because it does fluctuate. So that's why the S&P is usually on a cap strategy versus a par strategy because it mitigates a lot of uncertainty with markets. So, but I would pick S&P over anything as the majority any day of the week for consistency and just a cleaner opportunity. So kind of going back to what we talk about with this trail of performance, reallocate S&P, should say reallocate to S&P 500. So that should help, kind of put the paddles on and give it life again and give it a better trajectory than what it's at. So if, for example's sake, we go here, and I'm going to increase the size here so you guys see it better.
Hey, Phil,
Um,
are you meaning to share your screen? Because at least I can't see your screen at all.
uh-oh.
It works, we can see it.
Okay.
Probably try to refresh on your end. Probably the issues on your end, Rafael.
Yeah, I'll stop share and reshare. Let me do that and pull it back up. Let me know if you see the
Yeah,
win
I can
flex.
see it now.
Okay, cool.
Thanks.
No problem. So what we'll do is, because manner of familiarity, again, if I wanted to try and futz around with the FFIUL, I will. But let's say, for example's sake, we have a 29-year-old preferred best. She in Alabama too?
No, she's actually in Nashville.
You better not have come up here to see her and not said hello. That's all I gotta say. You did, didn't
Uh,
you? You did. It's okay. You're forgiven this time. This time only.
sorry.
Yeah. So, all right. So we'll take, for example's sake here, 300,000 and we'll do 2,500 and we'll assume she's probably going to do it till age 65 because everyone
Mhm.
feels like doing that. Um, Most people, that's another common misconception with LERPs. Most people will say, all right, well, let's fund it all the way to 65. Show of hands, how many people want to pay for the next 30 plus years on a life insurance policy? So I tell people, conservatively speaking, what can you do for the next 10 to 15 years?
Mhm.
Realistic expectations lead to realistic opportunities. You like the returns you're getting, you can keep adding money to it. You don't, we can shorten the duration, cut bait, figure out from there, but it's going to be a fluid policy. But most people, especially when they're like rookies in these multi-level marketing, will literally do it all the way to 65 and then flip it and come on right away. So I'm gonna show you this at the 100%. This is the MLSB. This is supposed to show the best returns, blah, blah, blah. And we're going to show increasing all the way to age 65. And then we're going to levelize it then. And is it 2,500 annually?
Yes.
Okay. All right. And then what I'm going to do here is I'm going to flip the script and I'm just going to show level the entire way. Calculate, little trick of the trade. If you didn't know that, you can actually do both by checking the box over here and hitting calculate up here versus the calculator in the top right hand corner. So it is going to run the illustration. Corebridge does take their sweet old time when it comes to calculating. So I like to fill the void. All right, so you'll see here 300,000, 2,500 in each category. I know it's going to last at least 65 because you see the premium payments go all the way to 37. So first and foremost, this is the increasing option. And just as I suspected, target, this is actually underfunding. So you'll see 300,000, 2,500 in plan premium, targets 3,000. I can actually put in on a $300,000 policy almost 13 grand a year. So the other thing I would look at on that illustration is looking for the guideline level premium. It can also be called the guideline annual premium.
Mhm.
Okay, so let's fast forward to the money page where we look at the actual illustration. And this thing is a floater. If you see here, there's no cash surrender value. There's literally no cash. I put in 2,500 and we have 908 here. And it's going to continue increasing, right? Because that's
Right.
what we asked it to do. 5158, 300 plus 5158, so on and so forth. And we go all the way to 65 or 66. And we've put in 92.5 and we have 212,000. Good story. People are excited. I put in almost 100,000. I've got over double. But let's go here. And again, remember, we're almost at 13,000 guideline level premium for a $300,000 policy. When you flip it to level, what it does is it reduces the cost of insurance. Now look at it. The guideline level is only 41 or 44.15. So we've shaved off about $8,000 in what I would consider overage and fees from increasing to a level. Fast forward, let's see how this policy looks on the money page. A little bit more, 908, 910, but let's see where we're at 66. So we got more cash there, 300,000 DB. So it's not too much more, but what it's going to do is going to save the policy in overage and fees, comparatively speaking. And this is just, again, a hypothetical. So it will prevent and mitigate issues. Now, the other thing is that Corebridge has some pretty decent fee structures. So if I showed this 6.36 compared to a Transamerica policy, their FFIUL illustrating at 7.25%, I could still outpace it from an illustration cash accumulation perspective. So it is a very unrealistic product. The only reason why they sell so much of it is direct distribution. Same reason why
Mm.
National Life Group is the number one IUL. They dominate a lot of MLMs, PHP, PFA, and they're circulating in other multi-level marketing groups too. So you'll see that people will tout things on the line, Aegon, Transamerica, first company to sell IULs. Well, I worked at Circuit City. They were out before Best Buy. Sadly. So, may they rest in peace. Things change, products change, and companies change. Are you in with the time still, or are you just focusing on your one distribution that's giving you this return? So, for anyone watching who's part of World Financial Group, not sorry. I'm really not. So, you just have to look at the foundation and the opportunity that's available for the client. There's a reason why I sell certain carriers. I don't typically sell like John Hancock accumulation products because John Hancock has high uh, cost of insurance. So they weigh it out with showing higher illustration rates than some of the competitors as well. So there's certain things that I always look for from a foundation for the policies and the structure. But I'll say it before. I've even said it when I was employed by these guys, and I'll say it again. Do not trust the index strategies that they provide for you. Focus more on the S&P. If you like a little bit of risk, like for my boys, I did 60% S&P, 20% in two different volatility controlled indexes. Worked fantastic, earlier this year. Now it's a dog with fleas, so it's gonna, balance itself out over
Mhm.
time. But for someone like your friend, I would
Mhm.
immediately switch it to level. If they can't reduce the face amount, switch it to level, and then ultimately, see if you can rescue the policy from that standpoint. But you should probably get contracted with Trans so you can become the servicing agent.
Okay.
May I ask
Okay.
a question? Can you go back, please, to the first few pages of the illustration where it says single guideline premium, I guess, and 7 pay premium usually. That's
Yep.
why I see. Does it mean so like the initial guideline single premium that the client can pay $65,000 one time? No. Okay.
No. What these are guidelines to dictate whether or not you're going to make your contract. So, what I tell people all the time is that if you try to put in 65 269, they'll give you most of that money back because you're going to violate the 7 pay premium and the guideline level premium. So usually if you violate a couple of these rules, you're going to get screwed up.
Mm-hmm.
So what's going to happen is then it would either mech it or they would send you most of the money back. Uh, people in the past would say, "Oh, well, I can just do 7 years of the 7 pay at 17,030." That won't work either. What'll happen is then you'll try and put this number in, and here I'll just show you. what happens is it gets funky for the first it'll work for the first 3 years and then it gets really funky. So if I do 300,000 and I do the 7 pay and then I just do, let's say, for 10 years, what'll happen, well, actually, I kind of alluded to it. I was going to ask you guys what you think will happen, but I already said something. So I screwed the pooch on that one. I should probably ask for more, you know,
So let me turn it around then the question. So the reason why we ask how much the client can afford is basically what's gonna dictate what they're gonna pay. So it's not we're not gonna play with like, okay, you have, like this low face amount, but you can actually prepay three times, 4 times more, and then just prefund the policy even more within the same pay, right? So you would still just kind of solve for the premium payments that she said, or like he said, the client.
yeah. Well, you want to solve for face amount when you're doing an income solve. Like here, like I said, the 17,030 is higher than the 12,945. But what'll happen is, so you'll see 17, 17, 17, 14, nothing, a little bit, and then you're at guideline level.
Mhm.
So you're going to get funky numbers. And I actually inherited a client who fell victim to this. So he actually got a letter from Corbridge saying, "Hey, I'm going to take you off of ABC draft because your policy will become a mech. You put too much into it, and it's only 5 years old." So now I have to remember in year 6 to call up Corbridge to see how much they can put in again and get them back on bank draft when they've been off of it for a year.
Mhm.
So how confusing and annoying is that for you to go back to a client and say, "All right, time to pull money out again at $500 a month or whatever it is." Well, I think it was 500 a month. So this is the stuff that can break a process on a sensitive product or a sensitive design. You have to really be on top of your game. You have to really also make sure some tricks that I do with LERPs is after I write it, sign it, sealed, delivered, it's yours. I then put in my calendar on my computer the name of the client, the policy number, and say policy review, and then put it on recurring annually. So I know to go back into my inventory of what I sold to pull it up because the carriers don't tell you when a policy, well, some do. Like I get them from Columbus. They say, "Hey, a statement is here." Other carriers are just like, "Good luck." Others will send you paper. I literally got one today. So it just depends on the carrier. But
What kind of message do they send you to change something about the policy, or I didn't get it.
they send you a message. So like in year 5 on this one, they sent a letter to me and the client saying we took you off bank draft. So we're not going to take money from you. Because if we took money, then the policy will become a mech, and
Mhm.
you're not designing it to be a mech. So I have to go back a year later and resurrect that premium to go back to the carrier
All
and
right.
have it consistent.
No, I get it. Thank you.
No, no problem. So, so yeah, I mean, again, it's a sensitive topic and a sensitive design. Unfortunately, a lot of people in this industry kind of hit it and quit it, and leave a lot of people orphaned. So when you think about that too, I always think about referrals and customer service. So if I were to sell a policy like this, and I've said this before, how bad would it be to just give an instruction manual of the process? Hey, Phil, I understand we're gonna fund for seven or $14,000 or 12,946 a year for 10 years. The objective is to then switch it to level at that point. You can call me if I'm still alive, obviously I'll help you. Or you call the insurance company and they can then simply change it from increasing to level. And then at 65, our objective was for you to start taking tax-free income. What we need to do is call up the insurance company, see how much we can take out on an annual basis safely, and then start withdrawals or loans. So to have like a one-page sheeter to give the customer elevates your value proposition and also can lead to more referrals. So it's a way to just get in front of more people just by doing the right thing, you know? So that's the most important part. But obviously, like always, I like to go on tangents. I used to get paid by the word. So Tia, did that help?
Oh, it helped a lot.
Hmm.
So
Yeah.
any other questions? You said you had a ton of them. I just don't know if I nailed them
No,
all.
I think you hit everything. I mean, I had an idea of what was going on, so I think I was going to ask a lot of questions, but you answered them all in one.
It's like I have 18 years of experience doing this. It's crazy. It's
Right.
crazy, you know? Crazy. So, all right. Well, glad we got that squared away. Gave a little extra value proposition and guideline level versus target funding and all that fun stuff. And we haven't even dived into any canned stuff. So this is a good night. This is a great night. Um, any other questions? Anything? Go for it, Till. What
I
you
might
got?
have one. I just don't want to really take up, so much time of the meeting from others. But it's just a really simple question. So let's say I have a client who's considerably young. I don't know, like, so let's say below 40. They have 25 plus years to fund a policy.
Mhm.
Because I remember we talked about buffering. So let's say not just solving for the lowest face amount, but also like kind of, increasing the face amount a little bit more so that they can fund more when they, make more money. Um, what
Yep.
is what is the best practice when you design policies so that I'm not screwing over anyone, and I'm
Yep.
literally, like having goodwill with the client of just designing the policy a little bit higher face amount by default.
Yep. So, for those of you who have had a few one-on-one conversations with me, I've done it a few times here too. What Attila is kind of alluding to is that you have clients who are young, they have a long horizon, but maybe not the amount that they want to put into it. So, Tia, yours is completely off the reservation between 2,500 and 13,000. However, if I were to approach, we'll use 29-year-old again, and you said to me, hey, or I say to you, all right, Tia, you're not 29. Sorry to make you older than you are, but let's just say you're 29 right now. And I say, Tia, how much do you think you could put towards a vehicle that could provide you tax-free income when you needed it? You don't have to wait till 59 and a half, but I just need to make sure you know what's comfortable for you today to ultimately invest for the next, say, 25 years. Well, Phil, I can do 2,500 a year. Okay. See how Tia's just voice changed and went completely monotone? It was crazy. So let's do solve for. We're going to solve for the face amount. We know the premium. We don't know the face amount. And we're going to do the minimum least amount of face possible. And you told me in that sweet voice of yours, 2,500 for the next 25 years. Okay. And then nothing after that. I'm not going to dive into index changes and strategies and stuff like that. We're just going to keep it simple. So policy options, we're going to do increasing for the 25 years and then levelize it after, and we're going to keep it annual. Disbursements, I'm going to show you here that if you want to take income, let's say at 65 for about 25 years, so age 90, the reason why I do this is because, let's be honest, about everybody on this call is probably not going to make it to 90. Might be a couple, you youngins, Penny, I saw that. You really want to make it to 90? Like, you know, this body is having problems at 43. God help me at 90, you know? So anyway, there's this research that was done. It was crazy. Spent a ton of money on it. Not me, the insurance industry. They found out the craziest thing. 100% of people are going to die at some point. Crazy.
Amazing.
So I know it's amazing. The things we spend money on.
Quick question, Phil. What happens if someone dies and they still didn't cash out the cash value of the policy? They only like the beneficiaries only get the death benefit, right? And the cash value just kind of evaporates or like disappears. So you kind of like if someone's getting really sick, but I'm just making it up, then it's
Yeah.
a good practice to cash out the policy and then literally just before they die,
Well,
right?
if you no, because then the policy would lapse. You wouldn't get the policy. So keep in mind, remember, there's gains in the policy. So if you take that, now you have a 1099 versus tax-free death benefit. So it builds on it. It's going to build it up. So like you'll see here, 2500 is only a $64,000 death benefit. So as you can see there, Tia. 240 extra $1,000 in death benefit for that 2,500 premium. But the person's probably not counting $3,000 in commission or 2,500 in commission. They would only be counting $611 in commission.
Hmm.
So womp womp. All right, so let's look at this. 64,603, 2,500 on this young lady. And we go for 25 years at 2,500. So we've put in 62.5 in the policy. As you can already see, we're over double at this point.
Hmm.
Okay. And now we can pull out a total of almost $29,000 in tax-free income. Okay. So we had started income at 290,000 and we're pulling out an amount of 28,848. So if I did simple math like 28,848 times by 25 years, that's about $721,000 in tax-free income. I did that all on the top of my head, I swear. Um, so don't mind the calculator that I just showed you. So from here, you've put in 62.5, you're pulling out about 700,000 plus in income. But, but 29 years old. Let's see. How much was I making at 29 years old? Right about, I think that's when I was a manager at Circuit City. So I was making about 40,000 a year. Baller. So when you think about that, compared to what you make today, the opportunity or the design is that do you think that at some point in the near future you're going to keep this preferred plus? Some people will say absolutely. These medals behind me was when I actually was healthy and was running, 5 miles every morning, 4 days a week, marathons, all that fun stuff. Now I just look at a mile and cry. So, you have a concern about if you can fund more money into a policy later, you have no space. We've already reduced the space low as possible. The guideline level premium is 2,500. The most I'm putting in is 2,500. I have no more space to put into this. So, if I not egregiously, but decided I was going to switch this to no solve, so this stayed the same. Now I'm going to double click on this. Let's just say 125,000. Okay. Yes, this is double $64,000. However, there's a couple things you have to consider. It is, in the grand scheme of things, not a huge jump. But what are we doing? We're increasing the face amount. So people will say, oh, you're screwing the client because now you're adding more costs of insurance. We'll pause for 1 second on that criticism. What we're doing first and foremost is we're giving someone a higher death benefit in case stuff hits the fan while you're working. It is not a egregious change. Now, 500,000, double it to 1 million, that's an egregious change.
Mhm.
But 64 to 125 is not. 274 to 400 is not, but 550 would be. So we'll look here and we'll see that we have a higher face amount, and now I can put in almost double what I was putting in before. So the guideline level is increased, and that would be me saying, hey, do you think you're going to be paying 2,500 the rest of your life? Or let's say most people have their peak earning years in their 40s and 50s. Do you think it would be smart to add a buffer or additional space where we could add more money to it later? Between us girls, we're getting a little bit more in commission, yes, because it's dictated based on face amount. But we've given higher living benefits, higher death benefit. Now let's look at the factor on what it does to the cash value. So same numbers here. Everything's the same. We dropped from 28.8 to 26.7. So we reduced it by $2,000 a year to give you the potential to add more money into it later. So we went from 721,000 to 668,000. That's still a 10 to 1 ratio on what you put into what you're taking out.
Mm.
So it's not egregious to the extent that I'm basically target funding, but to the extent that I have more space now to put more money into it later. And oh, by the way, let's say, for example, say 10 years down the road, you get that big bonus. You start making a ton of cash. Well, every year I've had $2,500 that I'm putting in, and let's just say 5,000 for even numbers. I could put in 5,000 per year. Well, I can put that 25,000 gap that I didn't put in, I could throw it in at one time and get caught up at the guideline level premiums. So that's the beauty of this too, is let's say your friend gets a bonus. Now all of a sudden they can throw money into it and put gas on the fire. And this 26,751 then turns into 50 $50,000 in tax-free income. So that's what I call a buffered strategy. It allows some room to build into it when you need it, but to not go super egregious like some people will do, a la the prior example, and just really butcher a policy. So that would be something that you could do that's not egregious, but still provide value to the customer. And what I would personally recommend is show both. So I think, yeah, Betty is on if she's listening. We just went through this,
Yes.
right?
Yeah. hmm Well, can I ask a question about this then?
Yeah.
If we have policies like this available to us where they can get all of this tax-free income, what's the main incentive of doing an annuity versus something like this? Is it just their insurability or?
It's a combination of a couple things. So if you do an annuity, for example's sake, there are no fees if you pick the right annuity. So if you did a Roth IRA and you were doing only 2,500, I should have more cash than $251,000 by 65.
Mm, okay.
Okay. But the perspective is that I gotta wait till 65, otherwise I'm going to incur a 10% penalty. And you have to wait 5 years for the money to be in the account before it becomes tax free. So there are levers inside of there that would warrant whether or not it's suitable for the customer. So if the customer wanted to retire at 50, they're crushing it. The Roth wouldn't make sense because now all of a sudden they have to wait till 60 to get their money. The other situation would be I've got a guy who's doing 130,000 a year for 10 years. So that won't work for a Roth because it's way too much.
Oh,
So
because of what you're allowed to put into it. per year.
Exactly. So when
Um,
you see these type of situations, and I'm not knocking anybody who does a 50 or $150 per month LERP plan, but I would highly encourage them not to, because you're going to run into minimums on the face amounts. 50,000 is usually the minimum for the carriers. And if you'll notice 2,500, I was close to the minimum for this carrier. So what happens is you might say, well, I'm only going to put 150 or, $100 a month in, and I'm in my mid 30s. That will do nothing. I would
mm,
rather people buy term insurance and protect the full need than try and listen to the TikTok influencers who say, put this money away to get tax-free income. Because we can give them protection and a Roth and ultimately win comparatively than doing this strategy. So it's just marrying the right product with the right solution. And through National Life Group, you can do as minimum of $100 a month into a Roth without a 5,000 dump in like most carriers, 5 or 10,000 in the dump in. So we don't make much, but who cares? I mean, it's recurring and you're helping the customer. So goes around, comes around.
and do I
What
need the
about
securities license to do that?
Nope, because
Oh,
it's in an annuity. Yeah. So if I pull up good old NLG here, so it's gonna do the stupid authentication. I know it is. Um, Big money, no whammy, no whammy, no whammy.
Hmm.
Come on, come on, come on, come on. Yes. Let's go. This is a great night. So, this is all inside of an annuity chassis. So let's just say we're going to do a fixed premium deferred index annuity. So right here we have the fit, secure growth, not the income, but the growth. And we'll just say Phil Resch, I am now 35. So why not? You'll see right here different options. So we do Roth IRA, funding
Oh,
withdrawals. Okay, I can do $100. Oh, sorry, that'll stay zero. I want to do $100 from 1 to 25. 1 to, yeah, 25. That'll get me to 60. Okay. And S&P point to point, it's a 9% cap. I'm okay with that because there's no downside risk. All right.
hmm.
And we got changes to monthly. Voila, quick view, 1,200 per year. And you'll see credit, so some good returns, some okay returns, whatever. But we'll look at 65 and I have almost 100 grand. And I've put in 1,200, so that's $24,000. So
Okay.
there's no fees attached to this. Downside protection, upside opportunity. Obviously, if they can put in the 7,000 or I think 8,500 is the catch up, you have a better shot at winning. But for someone who's like, yeah, I want to put in $50 or $100, and we'll say we can do 100, we can't do 50, and I would direct them towards the Roth IRA, but then say put another 20 or however old they are for like $1 million term. So you protect with living benefits, and then on the other side, you help them accumulate and grow. But if they can
Okay.
do 500, 300, 400, 500 and up, then the IUL is a conversation piece as well.
Okay. I think that helps. I appreciate it.
No problem.
what
That'd be what I
about
would
for
consider. Go ahead.
what about for a baby? And the reason I
Baby.
say that, I just thought about it. Yeah, I just thought about it, and the same person has somewhat of an identical policy for her son, but he's a baby, so he not funny.
I
It is.
know it is. Where
So,
where where in Nashville does she live? Can I go? No, I'm
what
just
is
kidding.
it? Well,
I mean,
She's right outside of Nashville. She's maybe Hendersonville, somewhere in there. Yeah,
Northeast. Yeah.
yeah.
Yeah. I'm in Franklin, so I'm 2 towns south. But
Okay. I'm in Franklin
yeah,
area.
well, you better call next time or else.
I will. I rarely come to Nashville, but
Hmm.
I will
Hmm.
next time. I will
I rarely
definitely
come to
come.
Alabama. I rarely come to Alabama. So anyway,
I'm sure I come to
I
Nashville more than you come to Alabama.
I did go to the Iron Bowl last year and I didn't call you, but I was with my family, so judge-free
See,
zone. Judge-free
see.
zone. Did you bring your family? So
No
anyway,
comment.
no tit for tat. Okay. So for kids, a lot of people will do it for that 529 alternative story, right?
Yeah.
So for those who don't know, 529s, you see them with FAFSA, could dictate or hurt your opportunity for grants and scholarships. Okay.
Oh.
So yeah. So that's why people do the life insurance because FAFSA doesn't look at that. And I'll use my kids for an example. They're smart. They must have got it from their mother because, I'm not smart. Um, my oldest, he qualified for Mensa. I had to Google what Mensa was. It's for smart people, if you don't know. But he got like a 34 on his ACTs, 36 is perfect, whatever. So he can get a full ride. So if I, for example's sake, did a 529 for my oldest son, now I got all this cash sitting in there and I got nothing to do with it. I got son number two, so this guy right here, he's he might not be the college type. Maybe he goes into a trade. Maybe he becomes Phil Jr. in Valor, who knows? I need a legacy, right? And so maybe he just doesn't go to college and he starts working with Papa Dukes. So now I got this 529 that I passed from first son to second son. Second son doesn't need it either. Well, I can position some into a Roth for myself, but not all of it. There's limitations and caps, and now all of a sudden I have a problem. I can gift it to my nephews, but why would I do that? My sister has to take care of her kids. I'm not here to take care of her kids. So the big thing is that there are some limitations and rules. What I would say is rule of thumb from me to you guys. If a client has a kid that's over 8 years old, the LERP or 529 alternative is probably not going to be the best option. Why? Because our policies need about 10 years to bake for it to even make sense. And the kid's 18 at that point. If you're going to do it at 8, that's kind of the cutoff. You could do 10 years of payments, defer it to after they get out of college, and then start paying it off using tax-free income. So like 22 to 26. Some people take the longer time to stay in college and, you have student loans till you're 40, but who's to say that will happen to your kids, right? But you can do stuff like that. Just like you'll have to take a look and see how much they're funding. So Tia, would I venture to say that they're doing about 2,500 for the kids as well? For
Uh, she said it was about 1,500 for the kid. He's two now.
that
I guess he maybe have been one when she took out
so
the policy, and it's still
what
the 300,000 death
God
benefit.
help. The kid would make more sense to be that high or not as high. But it would technically buy more coverage because he's younger,
Right.
being 2 versus 29. Um, the hard part I have about all of that is they could have at least just sold the mother a term policy for like
Mm-hmm.
500K. Because like let's play devil's advocate, right? You're sitting there like, well, I'm giving the kid a death benefit. I'm giving the kid 529 alternative. They're going to get tax-free income for retirement and the mother a death benefit, this or that. All right. Mother dies. Kid, husband, father just left on his own with only $300,000 to take care of the kid. Like,
Mm-hmm.
it was definitely greed before need because a kid by themselves for college, you want to put, as a factor about 150,000. And so this person obviously isn't looking at the entire picture. They were looking at probably about a $4 or $5,000 commission all
Yeah.
in. So, I'd probably do the same thing for the kid. Levelize the death benefit, same scenario, same situation, but it'll at least get a fighting chance. Like 1,500 is fine for the kid, but I would have bought term on her, and made sure that if she doesn't make it home tonight, there's a better conversation. So that's just my humble opinion.
I
So,
agree.
Roshni?
Phil, I'm sorry, Phil, I have a question on this.
Yeah.
So, in that case, are you recommending another term policy for the mom? That's what you said?
I mean, I would, because is she 29 now?
Okay.
She's 31 now.
31. Okay. Little trick of the trade that I saw recently, on the 3 Mark portal. Um, it was here for a while, I just didn't know it. This iPipeline over here. So this is a handy dandy kit that gives you, oh Lord. One sec. All right. So let's say Ms. Client, and she is 31, female, Tennessee. You're the only 10 I see. Let's just do a 20-year, $1 million. And you said best risk class. Kudos. Get quotes. Good Lord. So this is selected term, $24. Scroll down.
Mm-hmm.
You got the flex term for $26. That's cheaper than a meal at like McDonald's now. It's getting crazy. So, or one less trip to Starbucks, and you got $1 million to protect you in case something happens with living benefits. And I could just easily hit apply right there and go right to the e-application and start e-app. So, yes, Roshni, I think for $26 to protect from that standpoint would make a lot of sense. Um,
So, Phil, quick question on that.
yeah,
So, are you doing preferred plus or preferred
preferred
non-tobacco?
plus.
Okay. But in case if they have some medical issue or they are taking some medication, in that case, the premium would go higher, right?
Of course, anytime you have an ailment or issue, so you say standard, and we take off that, now all of a sudden the numbers change. But you're still looking at $50. It's double, but it's still $50. I mean, that's a tank of gas. So it's all in how you look at it. Beauty is in the eye of the beholder. So all things considered, I would say we're missing the protection side. Hell, Tia, I might even say just do the term policy and put 2,500 in a Roth.
That's what I was. That's actually I talked to her about it because she's upset, and so she's like, "I think I could save this money on my own." So if she can do that, she can do a Roth accumulate, and then
Yep,
just cover the death benefit.
yep. I'm thinking that might be smarter because, I mean, you could go through the whole process, keep the kid policy, just levelize it, but at least, because that has a future value, and 1,500 a year, is what, like $100 a month, $125 a month.
Yeah,
Nothing too crazy. But here, you're going to allocate, the money to go back here, for example, let's just say now I'm fill this, fresh,
Mhm.
right? So now you have 2,500 per year. So 65, she's got $271,000 in cash just if she starts today. So again, assuming rate of returns, pars and caps, all that stuff, but just a better story.
Wouldn't she have to surrender that policy with Transamerica then?
Yep. I would get qualified first with new coverage like this term. Once you get covered and blessed, then I would probably cut the losses because you can always convert this later to a permanent policy when you can fiscally afford to do so, but you're going to give her
Mhm.
20 years to do it.
Got it. That just makes
So,
sense to me.
yep. See, so full circle, right? Well,
Yep.
and two sales. Sorry.
Yeah.
Um, yeah, but yeah, again, I think for the embedment of the customer, no fees on the IUL on the Roth, and then you got, very minimal fees on the term. So you got full-blown protection. You're increasing her protection by 3 times, and you're giving her a better savings vehicle for retirement at this point in time. So, um, so yeah, I know we went longer than an hour. Um, Any last question? Does anyone have any final thing I want to ask? Good, good, good. All right. Well, I'll be on again tomorrow, 4 o'clock Central. We're going to talk about illustrating in a multi-carrier environment. So we'll talk about IULs, how to run several carriers at one time, and just say appreciate it. Again, for those who jumped on late, you're going to have a few bumpy weeks in regards to schedule because I'll be traveling a bit, but I will try and stay as consistent as possible. Maybe some special guests if my marketing guys are up for it. But yeah, lots to come. Hopefully, I will see all of you in 2, 3 weeks at the great collaboration. So, it's a day and a half of funsies, and really looking forward to it. So, I want to say thank you guys. Have a great rest of your night, and see you next time.
Thanks,
Thanks.
Phil.
Bye.